Let's review chapters 11 to 14. So question number 1 says Beth Corbin's regular hourly wage is $16 and she receives an hourly rate of $24 for work in excess of 40 hours. During a January pay period, Beth worked 45 hours. Her federal income tax withholding is $95. She has no voluntary deductions, and the FICA tax rate is 7.65%. The first thing that we need to do is compute Beth Corbin's gross earnings and net pay for the period. Once we have those amounts, then we can prepare the journal entries for Beth's pay for the period and the payment of Beth's wages. So let's figure out her gross earnings. So her gross earnings is the amount of money that she earned, right? So we were told that she worked 45 hours. So the first 40 hours of the week, that's her regular pay, and then she worked 5 hours of overtime, right? So her regular pay, $16 per hour. Overtime pay, $24 per hour. So then we just multiply across this table. 40 hours times $16 per hour and 5 hours times $24 per hour gets us our total amounts, right? So our gross earnings, we're going to add those two together. Because from the first 40 hours of work, she made $640, and then from the next 5, she made $120. So during that week, she made $760. Now we can figure out our net pay. So we see that our net pay is our gross earnings minus all of our deductions. So we have a few different deductions that we'll have to worry about here. We have our federal income tax. We were told that that's $95. And then we have our FICA tax. Our FICA tax, we were just given a percentage, right? We were told that it's 7.65%. So what we'll do is we'll take our gross earnings amount that we just found, that's $760, and we'll multiply that by 7.65%, or as we see on the screen, 0.0765, which will come out to $58.14. So that's your amount for the FICA tax. So now to figure out our net pay, we're going to need to find our total deductions first, right? So we add together federal income tax and the FICA tax. So we see that there's deductions of $153.14 from this week's paycheck. So your net pay is your gross earnings minus those deductions, which comes out to $606.86. So now that we have all of this, now we can prepare our journal entries. So first, the journal entry for Beth's pay for the period. It's going to look like this. We debit the expense, we debit the salaries and wages expense, and then we credit our deductions and salaries and wages payable. So our deductions, we know that our federal income tax, that was $95. We know that our FICA taxes, those were $58.14. Now, the other numbers that we have here are the net pay and the gross earnings, right? So what goes where? Your net pay will go into salaries and wages payable, right? So we have payable, net pay. We'll also see in the next entry why that makes a little bit more sense too. Then your expense is your gross earnings. So both expense and earnings both start with an E, right? So that'd be one way to remember to put your gross earnings into your expense account. Now, to prepare the journal entry for the payment of Beth's wages, we'll debit our salaries and wages payable and we'll credit cash, right? Because we are now paying Beth for her week of work. And we use our net pay amount. So we get this $606.86 from the previous entry. We see, okay, what did we credit salaries and wages payable for? This is now what we need to debit it for when we actually pay Beth for this week of work. So your payable amount corresponds with the amount that would be on the paycheck itself. right? Because that's the amount of money that the company is going to have to write a check to Beth for. So now if we take a look at question number 2, it says that McGill and Smith have capital balances on January 1st of $50,000 and $40,000 respectively. The partnership income sharing agreement provides for annual salaries of $22,000 for McGill and $13,000 for Smith. There's also interest of 10% on the beginning capital balances, and then any remaining income or loss will be shared 60% by McGill and 40% by Smith. So we need to figure out the distribution of net income. First, we'll assume that net income is $50,000, and then we'll do it again, assuming that our net income is only $36,000. So we're going to set something up like this, where we have our owners along the top, and then along the side, we'll notice that it says salary, interest, total salaries and interest, remaining income, and then division of net income. So this will be the framework for whenever we're dealing with partnership income sharing agreements and figuring out the division of net income. Then up along the top, we have our net income showing as our $50,000, right? So our first row is our salaries. So we're told that McGill had a salary of $22,000. Smith had a salary of $13,000, right? So we'll put those both in for the two different owners. And then we add them up over in that last column. So 22 plus 13 gives us our 35. Now, interest. We're told that the interest of 10% on the beginning capital balances is part of this agreement, right? So we take 10% of those capital balances that McGill and Smith had back on January 1st. So McGill had capital balance of $50,000. Smith had a capital balance of $40,000. So we see that 10% of $50,000 gives McGill an extra $5,000. 10% of $40,000 gives Smith an extra $4,000. And once again, we add them up in that total column. Now, this next step, we need to add together the salaries and interest. And why is that? Because our third piece of this income sharing agreement shows that any remaining income or loss. So we need to know how much is left over after these salaries and interest, right? So we'll add together the salaries and interest for McGill and Smith, and then once again show the total of $44,000 for both of their salaries and interest put together. Now we can move on to that step 3, where we show this remaining income or loss being shared 60-40. So we need to find out how much is left over. So what we do is we take our net income, that $50,000, and we subtract out the total salaries and interest for both owners, that $44,000 that we found. And that shows that we have $6,000 left over that we can split up. So we'll toss that into the total for the remaining income. This $6,000, this is what's being split 60-40. So we take 6,000 times 60% and we find 3,600. That's what's going to be going to McGill. Smith gets 40%, so we take the 6,000 times 0.4, and Smith gets that 2,400. Now, your division of net income, we take the total salaries and interest, add in that remaining income that we just found. So for McGill, that's 30,600. For Smith, that's 19,400. And then you'll notice that the total, the grand total at the very end, is 50,000. And that's your net income amount. So that grand total there will always equal your net income. Because what we're doing is we're dividing up that 50,000 between our different owners. So McGill gets 30,600 of it, Smith gets 19,400 of it. So now what changes when the net income drops down to 36,000? Well, salaries are still the same, right? McGill's still going to get 22,000. Smith is still going to get 13,000 because that's what this income sharing agreement lays out. Interest, it's still 10% on the beginning capital balances. So we still go 50,000 times 10% for McGill, 40,000 times 10% for Smith. Your total salaries and interest, it's the same as before, right? Because our salaries and interest did not change. So up to this point, everything remains the exact same as what we saw in our last part. What changes is this next piece. We have a net income of $36,000. Based off of this income sharing agreement, we're supposed to pay out to our owners salaries and interest that total $44,000. Those numbers don't match up, right? So here we're going to have a deficiency because we didn't make enough to pay out this full amount. So we take our net income, and once again, we compare it to our total salaries and interest, just like we did last time. And we see that there's this $8,000 deficiency. Now, the next step is just like what we did when we had remaining income. We're going to split this $8,000 between our two owners. So we take that $8,000, multiply it by 0.6, and we see that we're going to take away $4,800 from McGill. Smith, we take the $8,000 times 40%, and we see that we're going to take away $3,200 from Smith. Now, for McGill, we take the $27,000 minus $4,800, and we get this $22,200. Smith, $17,000 minus $3,200 leaves us with $13,800. And if we add together those two divisions of net income, we get $36,000. Now, what's important to remember here, McGill and Smith are still seeing their capital balances increase. McGill's capital balance is still going up by $22,200. Smith's capital balance is still going up by $13,800. Because the company still made a net income. The company still made $36,000. They didn't make enough to pay out the full salaries and interest and have a little bit left over, but they still made money. So their capital balances will still be increasing here after this division of net income. Now if we take a look at question number 3, it tells us that Ortiz Corporation issued 2,000 shares of common stock, and we need to prepare the journal entries for the issuance of that stock under the following assumptions. So the first one, the stock had a par value and was issued for a total of $52,000. Second one, the stock had no par or stated value and was issued for a total of $52,000. And then the third one, the stock had a par value of $5 per share again, but this time it was issued for land worth $52,000. So we take a look at that first assumption, right? We're issuing 2,000 shares of common stock, par value of $5 per share, and was issued for a total of $52,000. So how's this journal entry going to look? Well, we are receiving cash, right? Because whenever we issue stock, what are we getting back? We're typically getting back cash. So we'll debit our cash. We're going to credit our common stock because when we issue stock, we need to credit our common stock account. Then we're also going to see that we're going to have a paid-in capital in excess of par common. So this is an an account to show the amount that was received in cash that's in excess of the par value amount, right? So let's put in some numbers, then maybe it will make a little bit more sense. Cash, that's the amount of money that we got. That's our $52,000. Common stock is going to be valued at par value. So we take our number of shares that we issued, multiply it by our par value. So 2,000 shares times $5. So we'll credit our common stock for that 10,000. So just based off of par, our stock had a total amount of $10,000 that we issued here, right? Our paid in capital in excess of par is that remaining 42,000. Because we received 52,000, common stock was worth 10,000, so our paid in capital in excess of par fills in that extra 42,000 amount. Now, Ortiz Corporation issued the 2,000 shares of common stock again, but this time the stock had no par or stated value and was issued for a total of 52,000. So once again, we're receiving cash, and once again, we are issuing common stock. So we'll credit our common stock account. Here we don't have a par value. So when you don't have a par value, we'll just see that our cash and our common stock are the same amount. Now, Ortiz Corporation issued 2,000 shares of common stock once again. The stock again has our par value of $5 per share, but this time it was issued for land worth $52,000. So we aren't receiving cash, we're receiving land. So we'll debit our land account. Now, how did we get all this land? Well, we issued common stock, right? So we will credit our common stock. And then once again, we're going to be dealing with our paid in capital in excess of par account. So our land was worth $52,000. So we'll debit our land for $52,000. Common stock, we're going to be taking our number of shares times our par value. So 2,000 times 5 gives us that 10,000 again. And then we need to make our debits and credits equal, right? So we need to credit our paid in capital in excess of par for $42,000. Now, question number 4. Reinhart Corporation purchased from its stockholders 5,000 shares of its own previously issued stock for $255,000. It later resold 2,000 of those shares for $54 per share, then sold another 2,000 for $49 per share, and finally sold the last 1,000 shares for $43 per share. So whenever a company buys back its own previously issued stock, that's called treasury stock, right? So we need to prepare the journal entries for the purchase of the treasury stock and the 3 sales of the treasury stock. So first, dealing with the purchase of treasury stock, we will debit our treasury stock account and credit cash. And for how much? Just our $255,000, right? The amount that you purchased back these shares for. So that will be your entry whenever you are buying back treasury stock. Now, our first sale of treasury stock. We're going to sell 2,000 shares for $54 per share. So we're going to be receiving cash, right? So we need to make sure that we debit our cash. And we're selling treasury stock. So we credit our treasury stock. And you'll notice there's quite a gap in between our cash and treasury stock account here, right? It's because we're going to need another account in between those. So, how are we going to work through this? Well, your cash is your number of shares that you sold times the amount that you sold them for, right? 2,000 shares, $54 per share. We multiply those out, and we see that we need to debit our cash for $108,000. Now, treasury stock is going to be valued at the price per share that you bought it back for. So how do we find that out? We take the $255,000 that we spent on this treasury stock. We divide it by the number of shares that we bought back. And we find that when we bought back this treasury stock, we paid $51 per share. So we'll take that $51 per share amount, multiply it by our number of shares that we're now selling in this transaction, and we get 102,000. So we will credit our treasury stock for $102,000. Then we deal with our account called paid in capital from treasury stock. So we see that we're going to need more on the credit side. So that's how we know that we're going to be crediting our paid in capital from treasury stock here. How do we find this out? We take the difference, right? We take the difference between the 108 and the 102. Another way that we could do this is we take the difference in the per share amounts. So the amount per share that we are receiving in cash is $54. The amount per share that we bought back our treasury stock for was $51. So 54 minus 51 gets us a $3 difference per share. Well, $3 per share times 2,000 shares gives us our 6,000 amount that we see there. Then, when we're dealing with treasury stock, it's not a bad idea to keep a T account of our paid in capital from treasury stock. So we'll do that over in the corner, and we'll show this credit of 6,000 for our paid in capital. Now, our next transaction, we sold 2,000 more shares. This time, for a little bit less, this time it was $49 per share. So our journal entry won't look too different. Once again, we're still receiving cash and we're still selling treasury stock, right? So we still need to debit our cash and credit our treasury stock. Solve for the cash amount by taking the number of shares that we sold times the price per share that we sold them at. And we see that we need to debit our cash for $98,000. Now, treasury stock, we already found that those were $51 per share, right? It always goes back to that $51 for this group of treasury stock. So 51 times our 2,000 shares, and we need to credit treasury stock once again for 102,000. So you'll notice we need more on the debit side here. So we'll debit our paid in capital from treasury stock. So we are selling these treasury stock shares for less than what we bought them back for. When that happens, you'll be debiting your paid in capital from treasury stock. In the last transaction, we sold our stock for more than what we bought them back at. And that was when we needed to credit our paid in capital from treasury stock. So here, we could make our debits and credits equal and see that 4,000. Again, you could take the difference between the cash price and the treasury stock price per share. $51 minus $49 gives you a $2 per share difference. $2 times our 2,000 shares that we're selling here gives us that 4,000. Now we'll put that into our T account for our paid in capital from treasury stock, and we see that we're now sitting with a credit balance of 2,000. And this next part is when we start caring about that balance in paid-in capital. We're reselling our 1,000 shares here for only $43 per share. Remember, we paid $51 per share when we bought back all of this treasury stock. So we're selling it for way below than what we initially paid for. So let's look at this entry. We're still getting cash, so we still want to debit our cash. And we're still crediting treasury stock because we're still selling our treasury stock. So we'll find our cash amount by taking the number of shares times the price per share that we're selling it for. So 1,000 times 43 tells us that we need to debit our cash for 43,000. Treasury stock, once again, it's that $51 per share amount that we found times the 1,000 shares. So we credit our treasury stock 51,000. So in a perfect world, we could just debit our paid-in capital from treasury stock for the difference there, right? For that 8,000. But we cannot have a debit balance in paid-in capital from treasury stock. That account can only have a credit balance or a zero balance. So we take a look over at that T account and we see that we're sitting with a balance of 2,000. So that's the max that we could debit here. Because once we do that, we no longer have anything left in our paid-in capital from treasury stock. So we debit as much as we can into our paid-in capital from treasury. Then we have to dip into our retained earnings. So the difference between our debits and our credit here will be taken out of our retained earnings. And that's why we need to debit our retained earnings for 6,000. Because we sold these treasury stock shares for so much less than what we initially paid for them, right? $8 per share difference. So because that big gap is there, and we didn't have enough in paid-in capital from treasury stock to cover that gap, then we had to take money out of our retained earnings. So now question number 5 says, on January 1st, Frontier Corporation had $1 million of common stock outstanding that was issued at par. It also had retained earnings of $750,000. The company issued 40,000 shares of common stock at par on July 1st and earned a net income of $400,000. We need to journalize the declaration of a 15% stock dividend on December 10th if par value is $10 and the market price is $18. And then we need to journalize the issuance of that dividend on December 31st. Right? So a company could issue stock dividends, and what they're going to end up doing is they're going to end up giving their shareholders extra shares of stock. Right? So that's what we're dealing with here. But before we could even go into that journal entry, we need to do a little bit of math first. So we know that our common stock was worth a total of $1 million. And we know that the par value was $10 per share. So we can figure out, okay, how many shares did we have outstanding on January 1st? So we take the $1 million divided by $10 per share. And we can see that on January 1st, Frontier Corporation had 100,000 shares of common stock outstanding. But then it tells us that the company issued more stock in July, right? And these stock dividends aren't coming until December. So after July 1st, when we issued another 40,000, we're now sitting at 140,000 shares going into December. So we needed to find that before we could even talk about the stock dividend that's happening in December. Right? So now to journalize the declaration of this 15% stock dividend, what are we going to do? Well, we need to figure out how many shares are in this dividend. So we take our 140,000 shares that we have outstanding and we multiply it by the 15% that we're given as the amount for this dividend, right? So we see that this dividend will include 21,000 shares, meaning 21,000 new shares are being sent out to stockholders. Now, your journal entry, the first thing you need to do is debit stock dividends. So think of it as whenever you're declaring a dividend, you start off by debiting what kind of dividend you are declaring. Now, after we debit our stock dividends, we'll credit common stock dividends distributable, right? We aren't distributing these stock dividends yet, so we toss it into this distributable account, saying that we'll do it later. Then we have our paid-in capital in excess of par. Because our par value is only $10, our market price is all the way up at 18. Right? So because we have that difference, that's what tells us that we're going to need our paid-in capital in excess of par. So now our amounts. Your stock dividend amount will be your number of shares in the dividend, right? That's why we needed to find that 21,000. And we multiply it by the market price of $18 per share. So we see that we'll debit our stock dividends for $378,000. Now, common stock dividends distributable. This account will be based off of your par value. So your number of shares in the dividend multiplied by your par value, 21,000 times 10, gives us this 210,000. Then you're paid in capital in excess of par. Again, we know that our debits and credits have to equal, so we could just take the difference between 378 and 210. But how are they actually finding that? They're taking their 21,000 shares times the difference between your market price and your par value. So 18 minus 10 gives you that $8 per share difference. 21,000 times 8 gives us 168,000. So that's your journal entry for the declaration of this stock dividend. Now, the next part was the issuance of the dividend. So what we'll do here is we'll debit that distributable account, right? Because now we are distributing the stock dividend. So we can take it out of that distributable account. And what are we distributing? Common stock. So we'll credit our common stock here. And how do we get this amount? We go with the 210. We take a look at the amount that we credited common stock dividends distributable for when we declared our stock dividend. That's the amount that will then follow onto this issuance of the dividend journal entry on December 31st. Now, question number 6. Robles Corporation was organized on January 1st, 2016. During its first year, the corporation issued 2,000 shares of $50 par value preferred stock and 100,000 shares of $10 par value common stock. At December 31st, the company declared the following cash dividends. So we have an amount for 2016, 2017, and 2018. We need to show how the company will allocate these dividends to preferred stockholders and common stockholders, assuming that the preferred stock dividend is 7% and cumulative. So before we can deal with the allocation of the dividend, we first need to figure out what is the annual preferred dividend amount. So to find that, we take our number of preferred shares that we have times the par value for that preferred stock times our dividend percentage. So 2,000 shares times $50 par value times 7% or 0.07, and we see that every single year preferred shareholders should receive $7,000 in a cash dividend. We'll keep that in mind as we now deal with the allocation of this dividend. So we just take a look at 2016 first. And company's new, right? So don't have a lot to give out in cash dividends, but we did declare $5,000. Well, if we only pay out $5,000 in cash dividends, that means that preferred cannot get their full $7,000 that they're supposed to, right? Because there's just not enough money. So what's happening here is the first $7,000 every year will go to preferred. If we can't reach that, then we'll deal with it in later years. So preferred will get all $5,000 and common will get nothing. Common will receive a dividend once preferred shareholders are paid out the full amount that they're supposed to get. Right? So after 2016, we now owe $2,000 extra to preferred because this dividend is cumulative. Right? So cumulative means that if you didn't pay it out in previous years, it then builds up for future years. If this was non-cumulative, that extra $2,000 that preferred didn't get in 2016, they would just lose out on that amount. They would never see that $2,000. Here, they're going to see it in the future. So then 2017 rolls around, and we're doing better as a company, and we declare a $12,000 cash dividend. So how much are preferred supposed to get? Well, they're supposed to get $7,000 every year, right? So we'll remember that. But then we also owed them $2,000 from the previous year. So if we take $7,000 plus the $2,000 that we owed from 2016, preferred will get $9,000 in cash dividends for 2017. Now, common will receive anything that's left over, right? A total of $12,000. The first $9,000 are all going to preferred shareholders. So that means that there's $3,000 left over for common. And after 2017, we don't owe any dividends in arrears, right? There aren't any cash dividend amounts from previous years that we still owe. So we are all paid up through 2017. That comes into play now in 2018, right? 2018, a great year for the company. Now we can give out $28,000 in cash dividends. So what are we going to give preferred? Preferred gets their $7,000 because that's the amount that they're supposed to get every single year, right? We don't owe them from any previous years, and we're able to give them all $7,000 because we're issuing a total of $28,000. So they just get their $7,000 that they're supposed to get each year. Now, common gets anything that's left over. Well, there's a lot more left over now for common, right? So common shareholders get $21,000 here in 2018.